Good morning, everybody. Welcome to another Wealth Coffee Chat. A few of the early birds on already, which is awesome. Alison, Rodney, Kevin, evening, morning, evening. Nintendo, Ashley, hey, great to see you guys here. Thanks for joining me. Welcome to another Wealth Coffee Chat. Chris, pleasure as always. Great to see you, mate. Hope you're well. Hope you got a nice warm coffee wherever you are, Kev. Oh, Kev, how are you, brother? Haven't seen you for ages. We should catch up, Kev. Let me know when you're free. James. Good to see you, folks. Well, let's kick into it. Welcome to another Wealth Coffee Chat. Most of you know who I am, but if you don't, if you're new and you're dropping by, say hello. Let us know where you're coming in from. James Evos, this morning, brother. Shout out to the kids if they're in the car. Let me know. The Evendon kids. Hey, this morning, folks, I thought we might talk a little bit about rents and interesting times, interesting things going on. Melbourne is the centre of attention on today's conversation. So the York Peninsula, Sean, there you go. All the way up north. Well, good to have you on live anyway, Kev. The York Peninsula. Is that north Cape York stuff, Sean, or York Peninsula somewhere different? But wherever that is, fantastic to have you here, mate. Good to see all of you on this morning. So we might talk about the rents it's in South Australia. Okay. Completely opposite end of the country. Anyway, I better learn my geography a bit better. Anyway, there you go. But interesting times, as all of you guys know, that there's Brendan from Tassie. Brendan, good morning, mate. All of you guys know that interest rates are going up. At some point, those costs, which are real for you and me as investors, will pass on to the end user of your real estate, which will be a renter, unfortunately. Well, that's just the way it rolls. It's not like it's a terrible thing. These things are very normal, and if prices of your supply goes up, your supply cost of money has gone up, then, you would be, if you're in business, you would need to pass that on to your consumer customer because your profit margins would decrease and you would be out of business pretty soon. Same as in real estate. You have a micro business. In real estate, you have a cost. You've got an outcome that you want to achieve, and that's what you're looking for, right? So there you go. Interesting times in the world of rentals. We've talked about it. I've talked about it for ages. Vacancy rates at all-time lows, like all over the place. And it's been pretty interesting to see, team, that stuff changing. It's changed in a number of locations a bit quicker than places like Melbourne per se. I'm just going to see if I can grab one of these charts I've had just of recent times. But the places that the vacancy rates / rental increases have changed or happened a lot quicker. Add this. There we go. Have been in the places that have received either population growth, less construction, but a couple of places, well, one in particular in Australia, was affected or impacted the most when it came to lockdowns and the real estate market. When it came to rentals, not capital growth, by the way, but rentals. Which market is that? Tell me that in the chat. You guys know already the market I am looking to speak of. But which property market in Australia was impacted the most when it came to the rents, unfortunately, in Australia? And it wasn't every state of Australia that was impacted. Tell me, folks, tell me that one in the chat while I say a little good morning to Jeff, Brendan, Ingrid, Katrine. Yeah, Jeff, particularly inner city Melbourne, folks. Particularly inner city Melbourne. So let's have a bit of a conversation today. Melbourne, exactly. So if you have a look at, what's been going on, vacancy rates in our cities, wonderful cities, has been going down. Vacancy rate going down means the number of properties for rent have been decreasing, which means the pressure on that marketplace starts to bubble. And if you have a look at the vacancy rates in 2021, June, a year ago, in Melbourne and Sydney, let's do this. It's interesting because, those vacancy rates significantly high, folks, when we're talking about the real estate market, thousands and thousands of properties for rent. And then you have a look at the other marketplaces, and really, when we drill into this, it didn't take Einstein to work out we were going to have some pretty interesting times in those other states and other cities. Did it, and we talked about this. We talked about this significantly, and I want to talk about Melbourne in a minute. So stick with me because I want to paint the picture why Melbourne's late to the party, folks. Melbourne's late to the party. Brisbane and Perth and Adelaide and Canberra and Darwin, really just started rent growth, 12, 18 months ago. And, all the pressure started 12 or 18 months ago. So tell me, and this is kind of like, let's say the vacancy rates, let's say the number of available properties for rent in, let's say, Brisbane, Perth, Adelaide, Hobart, etc., reduced from 2020 to 2021. So that put pressure on the market, folks. Hopefully you can see that. So those number of properties reduced significantly over a 12-month period. Now the pressure's here in 2021. Tell me, folks, the pressure has arrived, low vacancy. How long now, or practically, how long does it take the marketplace to pass through any changes in rental prices? Now, interest rates didn't start going up until 2022, okay, which is kind of now-ish. So another 12 months later, all right, so we've had pressure in the market. So we've had pressure. We've had downward pressure. Oh, hang on, undo that. We've had downward pressure, but now our costs have escalated. How long now? Let's say today, and maybe in a few of the other states there was the opportunity, but not necessarily the need. So we had low vacancy, but our costs were flat. Okay, following along. Yep, boom. Someone's already answering my question before I could even form it properly. Thank you for that. So, folks, what's happened is the vacancy's gone down. There's pressure there. There's no supply, but there was no other reason for you to put your rent up other than, oh, yeah, that's fine. There's no real increase in my costs, etc. So now we see there's pressure still and vacancies are still going down, which means there's less properties on the market for rent. But now we have a real need in the marketplace 2022, June and onwards, because our interest rates are going up, folks. And what you will see, so whoever said that in their Facebook user, probably someone from the groups, over the next 12 to 24 months, let's say now from 2022 through to 2024 is where you'll see the full pass on of the costs of interest rates. And it hasn't, we're probably going to get, I reckon, 2 more interest rate rises, maybe 3, like as in cash rises. They're going to try and get it to about a 3% cash rate. At the moment, it's 1.85. So if they go another 0.5 and another 0.5, that'll get us sort of high 2s, and we'll see how we go. And there's usually a 2 to 3% margin on the cash rate, folks. So we're going to land at about 5 to 6%, maybe 4.5 to 5.5% interest rates. Okay, that's what's going to happen. That's what's happening. Oh, I don't want to use my home kit right now, thanks. There you go. So that's what we're talking about, team. So the full pass on of rental rises hasn't occurred yet. Anyway, hopefully that's making sense because I'm trying to sort of put the picture together here, team, with what we're up to. Okay, so if we have a look at the rest of the marketplace and we say, well, what's going on? Okay, which ones are kind of late to the party and which ones are kind of like done? Now this is not, I'm not talking about, oh, it's done, don't worry about it. There's still significant like vacancies and pressure on the market, team. So, you know, if we have a look at these ones here, you know, ACT, Hobart, you know, those ones, you know, the pressure on those areas is kind of there. It's kind of leveled out by the look of it. Doesn't mean it might not continue. Now, the rest of these cities here are now receiving the pressure flowing through, folks. Perth will start to get its mojo on. It's still late to the party, but we're talking Sydney. Brisbane's still under the heat, and Adelaide and Melbourne. Look at this. 53% less vacancies than there was a year ago. Okay? And we can see that with all of our stats and bits and pieces. Leading to, you know, some areas, especially in the apartment space, the unit space, 12-month changes in certain locations of 30% rental increases. 30% rental increases in these locations. You know, that's pretty good. I'm happy with that. Tick in the box, et cetera, okay? So, and does that mean, oh, wow, that's amazing. Wow. Stats are interesting when we have a little look at them. So check this out. I'm going to share my screen. Hopefully that's working. So let's have a look at this. Let me just make that a smidge bigger. Hang on. Over here. There we go. So look at this, team. 30% rises, which is great. Nothing wrong with that. But if we're talking 30% rise from the bottom, but we still haven't made it back to where we need to be, we've still got a long way to go, okay? All right, so this is what is called the mean reversion. I'll get a bit technical here for a second, so stick with me, okay? Stick with me here. So we're talking about, you know, this is Melbourne, you know, and then the rents went like this, okay? And we had this dip. There was a high here, and then we had a low because that was the middle of COVID. This is Melbourne, by the way, and we can have a look at different states and see if it's the same. So let's quickly go back to our share screen. Everyone see the dip here? So we went from a high of 589 average. This is units, all units, the average. And then look how far it dropped, ladies and gents. Folks, 370. That is hideous. Now, this is in the middle of Melbourne, by the way, folks. So yeah, just take that into consideration. This is the city where we wouldn't be buying anyway. You and I wouldn't be buying anyway, but I'm just communicating this conversation right now. We don't buy in the city, do we, folks? Tell me in the chat while I'm communicating here. Tell me in the chat, why don't we buy in the 00 postcodes, team? Yeah, as we go. So, and now it comes back to 540. And if we have a look at the same postcode and we go, okay, well, what's happening now? We've got mean reversion happening. But let's have a look at the vacancy rates. Yep. No, look at the vacancy rates at that point. Okay, so where we're at our bottom, and this is CBD postcodes, high risk, absolutely, Chris. High risk, no supply constrictions in a city, okay? What do I mean by that? In a city, in a CBD postcode, every city in Australia just rezones, no scarcity, dead right, Luke. And they just build high-rise after high-rise, and that's going to continue in perpetuity in cities, okay? Now, when you get the density of like 20 million people like in, London and Hong Kong and New York, well, it's a different story, but we're not there yet. Anyway, CBDs are to be avoided. The lenders, banks hate them. Banks hate double, triple postcodes, etc. Anyway, look at the vacancy rate there. So we were at a 10.6% vacancy rate. Now let's go back and have a look at where we were at our high. Folks, I want you to notice this. I want you to notice something here. At our high for rental, there was a 4.1% vacancy rate. 4.1. Listening. So here we go. Pay attention now. I want you to understand where 4.1. Let's go there. Let's go that. Let's not do 4.1. You can see 4.1's like what do you call it? Seasonal. Can you see how it goes? The students are here, now they're not. The students are here and now they're not because and the students are here. Can you see how volatile the cities are? Anyway, let's do at a low point. Okay, 2.1. Where are we now? We're at 2.7. 2.7. So, team, as we track along here, right? As we track along here, might need to move that actually. Move that over. I think there's something I need to do. Oh, there we go. There we go. A little bit better. So 2.7. If you see that now, you can, 2.1, 2.7, $500, $500, low, 10%. Can you guys see how this comes together with some of the data? And it's pretty self-explanatory. That's why, a lot of these reporters and stuff carrying on like pork chops reporting things are just hideous, all right? Anyway, so if we have a look at the data and we have a look at what's going on, for me, I'm saying, all right, we're going to see this continue to go down, right? That's going to continue to go down. And as that goes down, by and large, the rent should mean revert back to, what's going on over here, those rents, and they should continue to go up. That's what you'd think as you go. So hopefully that makes sense, team. Maybe a little bit sort of deep in the data today. But I thought for me and you guys this morning, let's just have a little chat about how you can analyze what's going on. The point is, if you want to have a look at maybe an area that you have a property in, let's say Melbourne, and will all of those properties go up 30, 40% right now? The answer might be no. The answer might be no. Maybe the vacancy in the area is still a bit low. Maybe the bulk of rentals hasn't changed over yet. So maybe you're the first rental to change in that sort of space. So you got to understand what you're sort of doing, right? So I've got a property in Collingwood, in Victoria. So obviously I'm looking to have a look at what might happen in the next little bit. So for me, I'm keenly looking at what's going on here. All right, so 2-bed units, looking pretty sharp. This was kind of the high, 617. We're back at kind of parity. Okay? So, this is, we're back where we were before or where COVID hit, team, as we go. So, for me right now, I'm keenly looking or keenly keeping an eye on what that might look like. And then, okay, can I see in my area the pressure continuing in Collingwood? And yeah, the answer is yes. I reckon it will, team. I reckon it will. 1.3, looks like it might come down. And you can see, along here in some places in Collingwood, there was low vacancies for quite a while. Then you had sort of COVID, and then vacancies coming back down. All right. So anyway, a little bit data heavy this morning. Hopefully you could appreciate it and keep up with the conversation this morning. But Brendan says, how much can people afford to rent before something stops, or is it when inflation slows down? Yeah, Brendan, it's an interesting one, isn't it? Inflation often is a weird one because there's some things that are out of your control as a consumer, and there's things that are in control. Like, so, you can pay extra for a TV if you've got some savings, and that's how inflation kicks along a little bit. But, petrol and interest rates and all sorts of stuff, become a real issue in that conversation. We've got actually, Brendan, we're going to get along a very clever chap to talk to us about inflation, government bonds, and what it means with interest rates. Now, I quite like that stuff, but it can be a bit mind-blowing. But, mate, you'll see people, spending less on things they don't need. That's what'll happen, Brendan. We have to spend on the basics, which are, food and shelter, really, at the end of the day. And if you can't afford to buy, well, you'll be renting. And that's certainly what happens for these cycles in the marketplace. So there you go. Lino, this website, mate, is called SQM Research. SQM Research, okay? SQM Research down here. There's lots of good stuff there. There's lots of free data, SQM Research. So, if you need to have a little look, this is a great website for. What did I call it? I did a wealth coffee chat the other week on some research websites. So track that one down. There you go. Yeah, it's certain there'll be a little bit of pain, Alison, for sure. And it's an interesting one, isn't it? Because there was a lot of COVID cash come out to businesses and people. So a lot of people put it aside. So it's kind of like this, the universe balances things out, right? It seeks a neutral position, and that's the same with money. Yeah. If you didn't earn the money, and this is not a comment on anyone who needed it, by the way. But if you didn't earn it, so if you didn't earn that extra, $100 or $1,000 or $10,000 the government gave you for free, often the universe just redistributes that later on because you didn't earn it. So, people. Yeah, it's interesting, Alison. I think that's going to be, a 6 or 12 month thing just because people need to survive. But the building industry has its different problems, let's say, to other industries. I know people in the world of accounting that couldn't get accountants to save themselves, right? So there's just nobody applying for jobs. And so different industries, different strokes for different folks. But there you go. We all need to understand what's going on. Understand it's kind of a normal problem. It's a normal thing that's going on from, let's say, a few abnormal problems. So there you go. Anyway, I'm just rabbiting on now. You guys be good. I think that's it. I'm done and dusted for today. I hope you're all awesome and well. And good to have you here eventually. Anyway, Joel, thanks. The rest of you guys, Chris, Luke, Jeff, Sharon, Katrine, whoever's still here, thanks for hanging out. Looks like my internet's starting to puff out now too. Anyway, I'm just rabbiting on. All right, you guys be good, be well. Join me tomorrow for Friday, Fabulous Friday. And